You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again at OptionAlpha.com, working every single week to make this the most popular investing podcast offered online because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So again, thanks so much for tuning in today. On today's show, we're going to go through some of the account changes or trade changes that you can make when you're trying to execute some straddles and strangles in a small brokerage account. And what I'm mainly talking about is accounts under $25,000. Now, I've used $25,000 as kind of like the baseline in the sand, but it doesn't have to be a hard line in the sand, but generally around $25,000 or less, you should not be trading straddles or strangles. You should be doing something a little bit different. And so we're going to be going through that here in the podcast today. Now, some of the questions that we're going to answer in the podcast once I get through some of the stuff are things like, what if I can't trade straddles and strangles? What do I do? How do I adjust the alerts to fit my current portfolio? So if you are a pro or elite member, how do you adjust those trading alerts to fit my current portfolio? Should I scale position sizes down or up? What about number of contracts? What about the spread width? Do I go wider with iron condors or do I go more narrow and do more contracts? What if I'm trading in a small brokerage account like $5,000 or $10,000? And finally, what if the commissions are eating too much into the profit potential after I factor in things like closing trades at 50%? So these are really all questions that people have, kind of submitted over the last couple of weeks, and I've put them together here and I want to talk about them in a podcast. Now, before I go into that, I want to actually mention something. And this is something that, I thought about mentioning or not mentioning, but I was recently approached by a company to do advertising on the podcast. And many of you know that over the last 8 years, we have had zero advertising on our website. We don't advertise anybody else. We don't have paid media. We don't have any of this stuff. It's all our content, or I should say my content on the website, because that's how I want to run my business. And I think it's important that I tell you guys that I, again, rejected another person to advertise on our show and on our podcast because people want to get to you. I mean, that's the end result. People want to get to you. You guys are an affluent audience for sure, and advertisers want to be in front of you. And I rejected a $15,000 a month retainer from this company. And the reason I tell you guys this is nothing more than to say once, thank you for supporting the podcast, and because everything that you guys do supports me and Option Alpha. And so if you leave a comment or a review or share this, that to me is more important than the $15,000 that I totally could have gotten by having some crappy company come on here and advertise their product or their service to you guys that had nothing to do with options trading. And again, I say this because I want you guys to know how invested I am in this for the long term. I have told people for years and years and years, I plan on doing this for a very, very long time. And so for me, I'm never going to trade a short-term gain in the sense of selling advertising on the podcast for the potential to build a long-term relationship with you guys. So I don't know. I thought it was important to mention. I think it's maybe insightful just to see kind of what's happening behind the scenes on my end. But like I said, it's not something that I want to do. It's not something that I've ever wanted to do, is do any advertising or, paid media on the website or the podcast. That's why you don't see it. And that's honestly why people think it's so refreshing when they come to Option Alpha, because it's just me and it's just my content that we're putting out there. Now, also, before we go through some of the things that we're talking about here today, I think I have to mention how important it is to have patience in the trading system that you ultimately select, right? So whatever trading strategy you want to really focus on, whether that's iron condors or straddles or strangles or iron butterflies or whatever the case is, you've got to have patience in that trading system. I feel like at the end of the year here, we've seen a lot of people that have just kind of thrown in the towel after a month or 2 months of trading. And it's purely out of a lack of patience and looking for that get rich quick type of system. And this is not that type of system. This is a positive expected outcome trading strategy that we try to deliver here at Option Alpha. It is not meant to be a 100% positive expected outcome, meaning you're always going to win every single month and never have drawdowns, never have losing trades. And it really drives me crazy to see people have a lack of patience in this business. And they wonder why they jump from thing to thing to thing, right? Why they do this and then they do that. And they have this shiny object syndrome, jumping back and forth between things. So I can't stress enough the importance of having patience in whatever trading system you ultimately select. And hopefully you are following some of the things that we're teaching here at Option Alpha and know that options trading does work. You just have to be doing it for more than a month or 2 months, or even sometimes more than 6 months to actually see the results. But it's not that it's not going to come up. So one of the things I use, and I'll use this today in the podcast just to kind of prove this point, like conceptually talk about it, is like, don't jump ahead or try to game the system. Like I've seen way too many people recently, and not only just in our pro and elite section, but also coaching clients I've dealt with. And then just a lot of emails that I get, because I get hundreds of emails a day, people trying to twist and bend the math, right? And they're trying to game the system. And I get it. I know why you're trying to do it. You're trying to, take your account that's $5,000 and maybe try to grow it a little bit faster than it should. But the reality is that eventually things are going to play out just the way they should. And the results that you are trying to achieve may not be present now in the first couple of months as they will be in the future, meaning that if you try to game the system and you try to over allocate or squeeze out a little bit more money or try to game the math a little bit more so that you can maybe squeeze out a little bit more money, it's going to come back and bite you in the end. And it may not be the first month, it may not be the second month, or even 6 months down the line. But believe me, the math always plays out. And so you can't game the system. Like I recently saw somebody email me and they said, hey, this has been working really well for me for the last 2 months. So, why don't you do this? And I'm like, well, because that doesn't work out long term. 2 months is not long term for me. I've been doing this for 8+ years. I plan on doing this for, another 25, 30 years. Like 2 months is not a long-term strategy for me. And so I feel like a lot of people are trying to game the system right now. And believe me, it's going to come back and bite you in the butt. 2 quick analogies that I think you should look at and think about is like, 1, smoking cigarettes. Like if you start smoking cigarettes right now, right? You might feel good. You might have some whatever the effects are of smoking cigarettes that you might feel good, but eventually it's going to come back and bite you, right? Like all of the, research, the science all proves that smoking cigarettes is incredibly bad for you, right? And that's what I feel like people are doing right now by trying to game the system, by trying to over allocate, trying to pick direction, trying to do all these things. They're smoking cigarettes in the options trading space, and eventually they're going to die of lung cancer and they're going to blow up their portfolio. The other analogy that I use, and I think about this often as a parent because I'm a father of 2 girls, is I use the analogy of kids doing homework. Like I would never tell my kids when they come home from school eventually and they say, Dad, this math is really tough. Like I don't know why I need to understand, math, and I don't know why I need to understand reading and, writing and all this stuff. And like that's a short-term thing where I know that they don't need to know it at that moment. Like you're right. You don't need to know it at that exact moment in time. It really doesn't serve you any purpose, but it's for the long-term outlook of your education so that you're a well-rounded person, so that you're definitely educated and you understand things conceptually and can solve problems. Like it's a long-term game. So I'm never going to tell my kids, hey, don't put in the work and do your homework, because eventually the results are going to play out the way that they should over time. So hopefully those things, kind of help you out as we get into this discussion. I think it was important to cover this first before we start talking about this stuff, because it's really, really stuff that's kind of like been on my mind and really like kind of driving me crazy inside. And this is hopefully a medium that I can get some of this stuff out and obviously, help educate you guys and help, get you on a different path. All right, so let's get into it here and start talking about, how we can trade straddles and strangles. Now, often people will always ask, and people who come into the pro or elite side will see that we do a lot of straddles and strangles in our trading system. And that's not because of anything other than those trades end up paying out more money. They generally have higher win rates and they have shorter durations or trading times. So we don't end up holding them as long. They make more money on average and they're really easy to adjust, right? So like that's why I do them. It's, 2 contracts versus 4. So I get it. But what if you can't trade straddles or strangles? Well, the end result here is that it's not the end of the world. In both cases, you can do what I call as the risk-defined cousin or the synthetic cousin to straddles and strangles. So in the case of a straddle, which those of you who are new to trading or relatively new to trading, a straddle is a short at the money call and a short at the money put. So if a stock is trading at 100, you would sell the 100 strike put and the 100 strike call. The way to convert that, if you are in a small account, is to do the synthetic equivalent of a straddle and create a risk-defined position. Well, how do you create a risk-defined position? You buy options far out on either end and create what's called an iron butterfly. So an iron butterfly is nothing more than a straddle selling the same at the money call, at the money put at 100, but now also taking some of that premium and buying those further out wings to create a risk-defined position. So in this case, if the stock was trading at, let's say, $100, you would go ahead and sell the 100 strike call, the 100 strike put, And then what you would do is you would go out a certain distance on either end, generally pretty far out, like $5 or $10 out, depends on the stock. And you would buy wings further out that define your risk. So you would, for example, buy a 105 call option and a 95 strike put option. Now, of course, in this case, you're going to take some of the premium that you would have taken in from that initial straddle, and you are going to use some of that premium to give yourself a risk-defined position. So you're going to take some of that premium and use it to purchase these long options, hopefully for pretty cheap amounts. I mean, I'm not saying you purchase them for $1, but in some cases it might be $10 or $15, depending on, the type of trade that you're doing. But you use some of that premium to create a risk-defined position. Now, the reason that this works now is because you can do this type of trade in an IRA account or a small account where you may not have undefined or naked trading privileges for your broker. So you can trade the straddle equivalent or the straddle cousin or synthetic by doing an iron butterfly. Now, the other way that you can do this if you're trading strangles. Now, strangles, for those of you who are new to options trading, are relatively new. A strangle is selling options far out on either end. So instead of, in our example previously where the stock was trading at 100, instead of selling the at the money strikes, you might sell strikes starting at, your short strikes would start at, let's say 105 on the call side and sell the 95 put on the bottom side. So again, this is something that we often do here. We do a lot of strangles and straddles here at Option Alpha. And so in this case, you're still undefined risk at this point. And so if you want to convert this into a defined risk strategy, you would again use some of that money that you collected by selling the strangle and buy further out wings to create a risk-defined iron condor. So that's how you would create a strangle synthetic, which is basically a risk-defined iron condor. It's one and the same. They have the same short strikes, but now with your iron condor, you're using some of that money that you collected with the strangle, and you're buying some of those options just a little bit further out. Now, the real difference here is just like how far out you buy options. With a straddle, you're buying options, far out, maybe $5 or $10 out on either end. With a strangle, you might only be able to buy options, $2 or $3 past your short strike. Because in this case, your short strike is already $5 or $6 out from where the stock is trading. So does that make sense? Because remember, if the stock's trading at $100 and our strangle has short strikes, or we're starting to sell options at 105 and 95 on the put side, we're already $5 out. So those options are worth less money anyway because we're selling a little bit further out. So now we have to be a little bit tighter on our spread width, buying those long options to create that iron condor. So hopefully that gives you just, again, the basic understanding of how you can create these synthetics in your account. And again, it's not that you can't trade these, it's just that you have to create a risk-defined position. The beautiful thing about what we do here at Option Alpha is that if we ever send out an alert about a straddle or a strangle, we'll always suggest the type of trade that you should at least start looking at to create a risk-defined iron condor or risk-defined iron butterfly. So we'll definitely give you those strikes and say, hey, look, if we're trading the 100 strike calls and 100 strike puts, you want to look at, XYZ call to buy and XYZ put to buy. Now, of course, that doesn't mean that that's the end result that you have to buy those. It's just that's a starting point to say, okay, this is what that strategy might look like if I'm trading in a small account or if I'm trading in a risk-defined IRA or retirement account. So next question most people have is, well, how do I adjust these alerts to fit my portfolio? Well, this is a really good question because as I say to pro members and elite members on our onboarding webinar, when you start trading with Option Alpha or start even just looking at some of the trades that we do and some of our live trading videos, because you don't have to trade with us, you can watch some of the stuff that we do in our live trading videos. When you start looking at those, might want to ask yourself like, well, how do I adjust this for my account? And there's one thing that you have to keep in mind with all of this as the overarching guidepost for how you adjust, and that is that you have to keep your portfolio and your position size in mind, and then you start working backwards from there. So what do I mean by this? Well, what I mean by this is that when I send out trading alerts, I'm sending them out based on my portfolio. These are my real trades. And so people will always ask like, Kirk, I see that you traded, let's say 5 of those, spreads or 5 of those straddles. I should do the same 5, right? And I say, no, that's 5 based on my portfolio, which is a couple $100,000 that I'm trading. So you should definitely scale down or scale up your position to fit your portfolio. So we have a great guide. It's a free download inside of our guides and checklist section on the website. You can get to it from pretty much every navigation menu on the website now. And it's a trade size and allocation guide, which tells you exactly how much risk you should be taking for your specific portfolio size. So once you have that trade size or that position size in mind, so let's say your position max size is $500. Okay, now you know that if you create an iron condor, you can at most have $500 of risk. So that means that you might be able to sell 3 iron condors, right? So 3 iron condors might still be less than $500 of total risk. Or maybe if you're trading some other stock, maybe it's a higher price stock like Google or Apple or Tesla or something like that. Maybe that 1 iron condor is $500 of risk. So in that case, you can only do 1. We might have done 5 or 10, right? But you can only do 1. It doesn't matter because it's still going to work out the same way for your portfolio as it is for ours. We're just maybe trading with a higher amount. And that means also not to say that my portfolio is the biggest one, because I know we've got a lot of members who are trading multi-million-dollar portfolios. And so I tell them, okay, scale up. So if we do 5, maybe you do 10 or 15 or 20 contracts so that you scale up. So it works in both directions, but I'm just specifically talking, obviously, if you're listening to this podcast, you may have a smaller brokerage account. So you want to scale down those position sizes. Now, another thing that people always ask is, okay, well, even if I scale down to 1 contract, Kirk, so if I just did the iron condor and it was just 1 contract and you did a $5 wide spread, what do I do now? Because it's still too big. Well, the answer to that is you need to make your spread width more narrow. So if you first scale down the number of contracts and you're just doing 1, at least to start, and you still have too much risk for that 1 trade, well, then you need to make your spread width more narrow. So let's say, for example, that I send out an alert and I even do an iron condor that's selling the 105 call, buying the 110 call, so a $5 wide spread on the top side. And then I send out the bottom side of that trade is selling the 95 put and buying the 90 put. So again, a $5 wide spread on that side. If that is too much risk for your account, which might be about $500 of risk depending on the credit that we take in, if that's too much risk for your account, then you need to make those spread wings a little bit tighter and more narrow. So you might sell the 105 and then buy the 106 or buy the 107, right? I sold the 105 and bought the 110. You might sell the 105 and buy the 106 or 107. On the bottom side, if I sold the 95 and bought the 90, you might sell the 95 and buy the 94 or the 93. Okay, so you're still going to have a high probability of success because it's still based off of that short strike that we sold. So you're still replicating or mimicking the same type of trade that I'm making, except you're just having to make your spread a little bit more narrow. Now that means obviously that the narrow spread you have, you're going to have less risk, but also less profit potential because it's going to cost you a little bit more money to buy those options that are a little bit tighter in. But again, it's for your account size. So you have to be patient in realizing that it's not going to prohibit you from growing in any means. It's just going to scale back the trade to fit your account size. It's going to make the glove, if you will, fit a little bit better versus trying to force this type of trade that may be too big or too large into your account size. Okay, so hopefully that makes sense about like how you do this, in relation to number of contracts and position size. Okay, it's all about looking at your total amount of risk and then scaling up or down based on that, contracts first, and then looking at the spread and trying to do either wider or more narrow spreads to fit your account. So last question that people usually have is, well, what if commissions are eating too much into the profit after closing at 50%? So I get this a lot. And this question really comes from the fact that people are, pricing out these trades and they look at an iron condor and they say, okay, this iron condor pays, let's say, $50 and is $2 wide, whatever the case is, right? And so they look at it and they say, okay, if it pays out $50 and then I have to close it at, half of the profit potential, that's only $25, plus commissions are eating in there. So it really doesn't make sense. Now, look, I totally get this. And I understand that this is a harsh reality of trading, that you have to factor these in. And I'm glad that a lot of people are looking at it in this light and really thinking about the entire process. So I'll always email back and say, like, you're thinking about the process the right way. Here's what you can do to adjust this. One, you can trade less contracts, but go wider in your spread. So instead of doing a $2 wide spread, maybe you do a $3 or $4 wide spread. Again, if your account size can handle it, if it's still within the 1 to 5% allocation in your account size, do less contracts and wider spreads. And again, what you're going to do in that regard is you're going to take in more money, but on one contract. So hopefully the commissions don't eat into it as much. I should have said this earlier, but obviously you want to try to get your commissions reduced. We've got a great podcast and show 17, I believe it was, that walks through how we reduced our commissions and how we continuously go through the same process of getting our commissions reduced. I think everybody could be trading on like $1 to $1.50 per contract commission at their brokerage. I don't think it's out of the realm of possibility to do. And we talked about that in show 17. So again, you can make the spread a little bit wider if commissions are eating too much into it. Now, what if you say to yourself, okay, well, Kirk, if I make the spread too wide, then it's over my position size. Great. What I say there is then convert most of your trades to becoming iron butterflies or something very similar to an iron butterfly. So really tight iron condors. And the reason I say that is because when you convert most of the trades to iron butterflies, you're taking in a lot more premium for that trade. Now, you're going to definitely sacrifice your win rate a little bit. So you're not going to have, let's say, a 70% winner on the onset. You might have a 58 or 63 or some difference in there of win rate you're going to be sacrificing. But for the time being, you're going to be collecting a lot more money, and they still have a positive expected outcome. So when we backtest, iron condors versus iron butterflies, they still have a positive expected outcome. And depending on your trade size and when you enter them, they're still both going to make money. But for the time being, if you have a small brokerage account, you want to focus on collecting as much premium as you can to really cover those commissions until you either get more money in your account, until it grows, or until you reduce your commission costs, right? And then you can start trading stuff that has maybe a slightly higher, profit potential. But that also means obviously that with the iron butterfly, you might be taking trades off a little bit earlier because you collected more money and you're going to take them off a little bit earlier for profit potential. I think at the end, it still makes better sense if you truly, truly have a really, really small account to do a lot of these iron butterflies or really tight iron condors. Try to collect as much premium as you can so that offsets the commission costs for your account, at least for the time being. All right, so hopefully that was really helpful. Again, if you guys have any comments or questions about stuff related to these lines, you want to head on over to the show notes page at optionalpha.com/show74. Again, that's just the number 74, optionalpha.com/show74.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question. Hey Kirk, Doug Hebel here, and I've been a pro member now for about 2 months, and I'm really enjoying the trading alerts and nightly video updates, so thanks for those. My question for the podcast this morning is, if we already have a 3% allocated position in SPY, for example, does this limit us to creating a second position in SPY to 2% until the previous position is closed? Or because these positions are separate, can we allocate 3% to each? I think you understand where I'm going with this, but I just want to know how best to think about per trade allocations when we are laddering positions like EWW and TLT recently. Thanks again.
All right. So Doug, I appreciate your question and thank you for submitting it. So the question, really is one that I get all the time. And that is, what do we really look at for trade size and allocation? And we even talked about this in the podcast show today, talking about, the importance of knowing what your max allocation is or what your scale of allocation is. The easiest way that I can answer this question is that no ticker symbol should represent more than 5% of your account. And that's really the most simplistic way I can say it. No ticker symbol should represent more than 5% of your account. So in your example, if you had one trade in that ticker symbol of 3%, then you want to get into another trade of 3%. Well, that's 6% for one ticker symbol. And I personally don't believe that more than 5% can be in any one ticker symbol. So you divvy out the 5% as however you want. You can do 5 trades of 1%, or you can do, a couple trades of 2, 2, and 1, whatever you want to do, but no more than 5% per ticker symbol. And I think that will really help kind of answer and solidify that question for you. So again, if you'd like to get your question answered here on the podcast or live on Facebook and Periscope in the future, please head on over to optionalpha.com/ask, click the big red button in the middle of the screen, leave me a private voicemail. It goes right to me. There's no software to download or install, and it's incredibly easy. Now, before we go to the closing bell segment, I want to let you know how you can get your hands on our freebie today, and that is our Ultimate Options Strategy Guide. It's completely rewritten. We expanded it out to 90 plus pages with little cheat sheets at the end of this workbook that go through line by line how you get into some of our top strategies and some tips and tricks on how far out to place trades, how to exit the trades for optimal win rates, how to have stop losses if they require stop losses, the whole deal. It's all completely free, and you can get it by going to optionalpha.com/ebook or by texting in the word strategies. That's all one word, STRATEGIES, strategies, to the short code 44222. And that's so if you're on a mobile device right now, you can't get to the website and do it, you can text in the word strategies to 44222, and then you just reply with your email address. We'll send it over to you right away. It's completely free. We give it away for free. There's nothing attached to it, no upsells or anything like that. It's just really good content that we've written that we want to get into your hands.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, we're actually going to go through a new trade that we just got into, and that was a new iron butterfly trade in XLV. Now, I selfishly got into this trade today, not only because it was a good trade, but also because I was doing this podcast. I knew I was going to be doing this, so I kind of jumped into this trade, and I want to get into this trade for sure because it's just really good content for the show. So we ended up doing a trade in XLV. Now, XLV is an ETF that tracks basically the healthcare sector, and it's been all over the place since the election. I mean, it's had a low of 65, it's then quickly run up to 72, then all the way back down to 67, and now it's kind of, trending somewhere in between. So it's really been all over the place. I mean, definitely a classic example of market asystematic, movements and, kind of random movements, because it's been all over the place in the last month and a half. But in that time period, implied volatility has been pretty good. So it's generally pretty high. It's one of the highest ones that we have right now on our watch list. And so we want to get into a trade. Now, because this is a higher price security in the $67.50 range right now, what we want to do is we want to do an iron butterfly. So I'm actually doing an iron butterfly in this case because it just makes more sense. The margin that's required for this trade to do a straddle or a strangle is just ridiculous right now. I mean, you're not collecting enough money to really cover any sort of, meaningful return with margin right now. So the iron butterfly makes sense because the out of the money options are pretty cheap. And so I want to walk through this process with you guys here today. So the baseline of this iron butterfly is the straddle. So again, we are selling the straddle as the core foundation of this trade, and that is the 67 call and 67 put. So we're selling basically at the money strikes. We're being a little bit bearish in our directional tilt here, but we're selling at the money strikes at 67 on the call side and the put side. Now I could do this trade by itself just like that, and I would collect about $290 or so in premium, okay? But what I want to do is instead I want to go out a certain distance on either end, and I want to buy wings on either end that give me a risk-defined position. So instead of doing just the straddle, I'm going to convert this into an iron butterfly. And the way that I do that is I go out $6 on either end, and I convert this into an iron butterfly by purchasing the 61 put options, which are $6 out on the lower side, and I purchase the 73 call options, which are $6 out on the upper side. And the 73 call options are only worth $5. So of the premium that I've collected on basically the straddle or the inside legs, I'm only spending $5 for the call side. On the put side, because puts are naturally a little bit more expensive, there's a lot of put skew, and people usually buy puts for insurance on their portfolio. The 61 put is a little bit more expensive at $26. So overall, I'm spending about $31 of my premium to buy protection and create a risk-defined position. Now, in this case, the credit that we took in, net credit of all the buying and selling, was $267 per spread. So we took in $267 of total credit per spread. And what that means is that leaves us risk of $331 per iron butterfly that we're doing. Now, how did I get to that number? Well, you take the spread width on either side, the maximum spread width, which is $6. Remember, we went out $6. You subtract the net credit that you received, the $267, and that gets you your risk per spread. So in this case, if you have a portfolio that can handle $331 of risk per trade, if that's under 5% for your account, then that means that you can do this type of trade with us. Now, I did a couple contracts, so I didn't do just one contract. I did a couple of these. So you would scale down or scale up based on your account size. If you can only do one, great, scale down to one. Don't do as many as I did. If you have a larger account, then you want to do more than this, great, scale up or make the spreads wider. Let's say that $300 of risk is still too much for your account. I'm trying to be really, cognizant of the people that we might have listening to the show. Maybe $300 of risk per trade is still too large, even if you scale down to one contract. So what you want to do instead is you want to move those strike prices in from $6 to $5. Now ask yourself, okay, how does that change the payoff, the credit that I get, and the risk that I have in the trade? And so you start moving those wings in a little bit more. Now, I think obviously there comes a point where you can't move them in, all the way. You can't have them be $1 out because your potential payoff is not going to be that high. It's going to be like a regular butterfly trade, which they don't win that often, right? So I think you move them in maybe at most, $1 or $2, see if it works. If it doesn't, then try to look at the iron condor or try to look at, some other combination of wings and spreads, to see if you can get something that kind of fits your portfolio. But I just want to go through this with you guys here today so you can see at least a live example on the show of what we're doing in our portfolio here with this iron butterfly trade in XLV and how maybe you can convert that to be a better trade for your account if you're trading in a small brokerage.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, now I truly hope you enjoyed today's show and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader investor. As always, you can get additional resources and links mentioned in the show, plus some related video training from today's show by going to optionalpha.com/show74. Again, that's just the number 74, optionalpha.com/show74. Until next time, happy trading.